Financials in focus today as the big banks have nothing to stress about, with 34 out of 35 firms passing the Fed's key hurdle, with Wells Fargo the biggest winner on the day. But it wasn't all rosy as the Fed flunked Deutsche Bank's U.S. unit. Our Wilfred Frost sat down exclusively with their new CEO, Christian Sewing. Here's what he had to say.
I think we have shown that from a robustness, from a solidity of the bank, we have shown strong results in the quantitative stress test a week ago. We are very happy about this because there was a lot of work which we have put into this one. And we know that on the control side, we had deficiencies. We have done good progress, and we are completely committed to work with the authorities to get that even better right over the next year.
So should we be a believer in Deutsche Bank, or is it a warning sign here, the fact that it failed the stress test?
It's kind of hard to still be, either you believe it's going out of business, which I don't think many believe it's going out of business. It's down 44%. So if you're, it's kind of like betting against the $2 number. If you think that financials are going to be challenged, and specifically Deutsche Bank is going to be challenged, you don't really, I wouldn't short it, put it that way. But down 44%, to take a flyer out on it, I think there's upside surprises a lot sooner than there are downside.
Here's the deal, folks. I mean, Deutsche Bank systemically is a major institution globally and absolutely isn't going anywhere. But their U.S. business, in terms of the operations that they run here in the U.S., and that's sales and trading, that's an investment banking business, you know, it's possible that this is a business that they decide that they don't need at some point. Ultimately, I'm not sure that that's a tell on the rest of the banking sector. I know people want to do that, but when I see Deutsche Bank going through difficulty on their own side, I think it's a Deutsche Bank problem.
All right, separately, though, we saw the financials trade horribly today. I mean, we had big gains. We were all sitting here. Most of us were sitting here last night.
Not all of us.
Not all of us, but many of us were sitting here looking at the CCAR results, seeing the banks trade up 1-2%, and they were not able to hold those gains today.
Let's go ahead.
And I'm not saying that it's a warning sign that something's wrong with them. I'm just saying that it's not good price action if you're an investor in the stock.
Well, I mean, look at the one that really outperformed. I mean, really, Wells Fargo, I mean, kicked it. I mean, it outperformed because of the buyback. The buyback was significant. Street was expecting $15 billion. They came in at $24 billion. It outsized what expectations were. I think, like Citi was a great you know, sort of news, you know, headline for them. The stock didn't necessarily react to it because it was expected.
To me, CCAR results came in as expected, possibly with the exception of Morgan Stanley and Goldman Sachs. So I don't think we should have rallied extraordinarily. What was new? What about the banks has changed? And I'll take that on the other side. I don't think, I said this last night, I'm going to say it again. 6 months, nothing's changed in the banking story other than a flat yield curve, which doesn't change the investment.
But the reason why they rallied, though, originally was we were down 13 days straight in the XLF. It was a pop.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.